Imagine running a restaurant where, like, every single customer walking through your doors is spending less money than they did last year.
Right, which sounds like a total nightmare.
It does. And on top of that, your beef supplier just called to say they are hiking prices by a staggering 20%.
Oh, wow. 20%.
20%. I mean, by all normal business logic, you should be panicking right then and there.
Yeah, you'd probably be prepping for bankruptcy at that point.
Exactly. You'd be calling the lawyers. But today we are looking at a company that took those exact ingredients and somehow, against all odds, cooked up a record-breaking profit.
It's a totally counterintuitive setup, isn't it? I mean, It completely defies the basic gravity of restaurant economics that we've all been taught to expect.
It totally defies it. And, well, that is exactly our mission today. Welcome to a very special Talk Tickers edition of our Deep Dive.
Glad to be here. We've got a lot to unpack.
We really do. So we are ditching the Wall Street jargon today. We are leaving the ivory tower behind to give you, the retail investor, a data-forward, actionable, and, plain English breakdown of what is actually happening under the hood of these companies.
Because there is so much noise out there right now.
So much noise. So today's target on the operating table is BJ's Restaurants. Ticker symbol, DJRI.
Good old BJRI.
Yeah. We are tearing into their Q2 2026 earnings call transcript. And we chose this specific company because the casual dining sector right now is, frankly, a total bloodbath.
Bloodbath is honestly an entirely appropriate word for the macro environment out there.
Really? Like it's that bad?
Oh, it's brutal. I mean, we're seeing legacy chains shuttering dozens of locations overnight.
Right, I've seen the headlines.
Yeah, we're seeing strategic bankruptcies. We're seeing companies just slowly bleeding out from like 1,000 paper cuts of sticky inflation and these wildly shifting consumer habits.
Consumers are just stretched incredibly thin in 2026. You read the financial headlines and you'd think, nobody's eating sit-down meals anymore.
Right, everyone is supposedly trading down to the drive-thru to save cash.
Or they are just eating at home. But then you pull up the transcript for BJ's Restaurants and the narrative just completely flips on its head.
It really does.
Hey, so let's unpack this. We need to start with the headline numbers because they form the foundation of this entire story. If you're going to hold this stock, you have to understand the baseline.
Yeah, the top line numbers are where the rubber meets the road. They tell us if the thesis even has a pulse before we start dissecting it.
Okay, let's fire them off. Total revenue for Q2 hit $388.9 million.
Which is big.
Yeah, that is a 6.4% increase year over year, which, right out of the gate is not too shabby for a company operating in a sector that is supposedly dying.
Not too shabby at all.
But let's go deeper. Adjusted EBITDA came in at $44.4 million, up from $42.1 million in the same quarter last year.
Nice, steady climb there.
Right. But now, before we move 1 inch further, let's translate that because I hear EBITDA thrown around on CNBC all day long.
Oh, constantly.
Earnings before interest, taxes, depreciation, and amortization. But, what does that actually measure for a restaurant? Why do we care?
It's a great question because, honestly, the acronym itself is practically designed to put people to sleep.
It really is.
Think of EBITDA as the raw, unfiltered cash the restaurant generates from simply selling food and drinks before the corporate accountants step in.
Okay, so it's basically the operational cash flow.
Exactly. It's before you deduct the taxes you owe the government, before you pay the interest on your corporate bank loans, and crucially for a restaurant, before you account for depreciation.
Right, depreciation.
Yeah. Because depreciation is an accounting trick. It acknowledges that your pizza ovens are getting older and, your booth vinyl is wearing out.
But I'm not writing a check for booth vinyl every month.
Exactly. Depreciation isn't a cash expense today. You aren't writing a check for it this month.
Yeah.
So EBITDA strips all that noise away.
It just tells you if the core business is working.
Right. It asks, did the fundamental act of buying ingredients, cooking them, and serving them to guests actually generate cash? And for BJ's, that raw cash engine is definitely revving up.
Okay, that makes sense. It's the purest measure of the model working. But there's another metric in this transcript that management just kept hammering, and I need you to break it down.
Sure, lay it on me.
They said their restaurant-level operating profit margin expanded by 20 basis points to 17.2%.
Yes. The beloved basis points.
First of all, let's ELI 5. This explain it like I'm 5. What exactly is a basis point?
A basis point is basically just Wall Street's way of trying to sound smart when talking about tiny percentages.
Right.
1 basis point is 1/100 of a percent. So 20 basis points simply means 0.2%.
0.2. Okay, so their profit margin at the actual physical restaurant level went up by 0.2%, landing at 17.2%.
Correct. And, while 0.2% sounds like a rounding error, in the restaurant business, margins are notoriously razor thin.
So, for sure.
So protecting your margin, let alone actually expanding it during an inflationary cycle, is a massive victory.
It really is.
It basically means for every $100 that comes through the door, they are keeping $17.20 at the store level, which is better than they did last year.
Okay, so revenue is up, core cash flow is up, margins are up. Sounds like a flawless quarter, right?
You would think so.
But here is where we hit our first massive contradiction, the anomaly.
Yep, the weird data point.
When you look at their comparable restaurant sales or comps, meaning sales at restaurants that have been open for at least a year, stripping out the new store openings that inflate the numbers comps, grew 6.5%.
Which is a huge number in this environment.
Huge. But when you break down exactly how they achieved that 6.5%, it gets incredibly weird.
It really does.
Guest traffic was up a massive 8.3%. But the average check, the amount of money each of those guests actually pulled out of their wallet, was down 1.8%.
Yes. The dreaded phenomenon known in the industry as check compression.
Wait, okay. I have to push back on this right out of the gate. Let me put on my skeptical investor hat for a second.
Go for it.
You're telling me they had way more people coming through the doors, 8.3% more bodies sitting in booths, but every single person, on average, spent less money.
Yep. That's what the data says.
In a 2026 environment where the food they're eating costs more to make. As an investor, my gut reaction is to absolutely panic if the amount of money a customer is willing to part with is shrinking.
It's totally understandable.
How is working harder to serve more people for less money per person a good thing?
It is entirely counterintuitive.
Yeah.
And it's totally fair why that sets off alarm bells for you. I mean, in a vacuum, you always want your customers spending more money every time they visit.
Right. Always.
But we don't live in a vacuum. We live in a highly pressurized macroeconomic environment where consumers are aggressively managing their discretionary budgets.
So people are just being cheap.
Basically, yeah.
Yeah.
Let's talk about what check compression actually looks like in the dining room.
Paint me the picture.
Okay, so check compression happens when your guests consciously shift their buying behavior to protect their wallets.
Okay.
It means the regular customer, who usually comes in on a Friday night and orders, say, the $30 ribeye steak and a $9 craft beer, they still come in. But this time they order a $16 chicken sandwich and a water.
Ah, I see. Or they just skip the appetizer entirely.
Exactly. Or, in BJ's specific case, they lean heavily into promotional bundled meal deals, which we will definitely get into later.
Right, the bundles.
The result is the overall ticket price drops. Now, to your question, why isn't this a disaster?
Yeah, because my instinct is that if they are spending less, the restaurant is making less profit. Period.
I get that, but you have to look at the unit economics of a massive, 7,000 square foot casual dining restaurant.
They're huge buildings.
Massive. And these buildings have immense fixed costs. The rent or mortgage is exactly the same every single month.
Yeah.
The property taxes don't change. The electricity bill to keep the lights on and those massive air conditioning units running is mostly static.
And the management salaries?
Yep. The salaries for the general manager and the kitchen manager are completely fixed.
So basically, the overhead doesn't change whether there are 10 people in the dining room or 150 people in the dining room.
Precisely. Those fixed costs exist just to unlock the front door every morning. So in this specific environment, capturing market share, which means driving sheer traffic, getting bodies into those booths, is infinitely more valuable than trying to squeeze an extra dollar or two out of a shrinking pool of customers.
Okay, I think I'm tracking.
If you can drive 8.3% more traffic, even if they are spending 1.8% less per person, those extra bodies are absorbing all those fixed costs.
Let me make sure I'm following the math on this. Let's use easy numbers.
Let's do it.
Okay, let's say last year, 100 people came in and spent $20 each. That's $2,000 in revenue.
Yeah.
This year, traffic is up, let's say roughly 10%. So you have 110 people coming in. But they are spending slightly less, let's say $19 each. 110 times 19 is 2,090. So top line revenue is higher.
Yeah.
But you're saying the profit on those extra 10 people is what really matters.
Yes, because the cost of cooking for those extra 10 people is basically just the raw ingredients.
Wow.
Yeah, because the rent is already paid by the first 100 people. The AC is already running. The managers are already on the clock.
So the margins on those extra 10 meals are huge.
Exactly. The gross profit margin on those extra 10 meals flows almost directly, beautifully to the bottom line.
That makes so much sense.
And that is exactly why you saw their overall restaurant level operating profit margin expand by 20 basis points. They happily traded a tiny bit of check size for a massive surge in volume.
So volume is king.
In the restaurant business, volume cures almost all ills.
Okay, that completely clarifies it. It's like the difference between a high-end boutique trying to sell one Rolex a month just to survive versus a massive department store selling like 10,000 Swatch watches.
That's a great analogy.
The profit per watch is tiny at the department store, but the sheer volume of cash generated is what pays the dividends and expands the business.
Exactly. And look at the strategic long-term victory here too.
Oh, what do you mean?
In a market where your direct competitors down the street, the other casual dining chains, are seeing negative traffic, their dining rooms are physically empty.
Right.
By offering a compelling value that causes check compression, BJ's is actively stealing those customers.
Oh, they're eating their lunch, literally.
Literally. They are getting them into the BJ's ecosystem. They are building a habit. If a family has a great time on a budget today, they will remember that.
You are acquiring the customer for the long haul.
Right. Management can always figure out how to upsell them later when the economy improves. Right now, it's a land grab for foot traffic.
Okay, so if they have all these people spending less, how did they get them in the door in the first place?
That's the real trick.
Because driving an 8.3% traffic surge in a tough economy isn't an accident. People don't just spontaneously decide, entirely by coincidence, to all flock to BJ's on the same week.
Definitely not.
There has to be a catalyst.
Let's dig into the story behind these numbers. What is the actual mechanism driving this foot traffic?
It comes down to a very deliberate, surgical shift in how management deployed their capital, specifically their marketing dollars.
Okay.
During the earnings call, CEO Lyle Tick referred to the second quarter as their celebration season.
Right. Q2 is the gauntlet of spring events. You have Mother's Day, Father's Day, high school graduations, college graduations.
It's packed.
These are the heavy hitters of the dining calendar.
Exactly. And what management did was fascinating from a capital allocation standpoint. They essentially starved their Q1 marketing budget to overfeed Q2.
Wait, they just abandoned Q1?
Basically, yeah. They took advertising dollars that historically would have been spent in January, February, and March, and they shoved all of that money into the second quarter. But why would they do that? Is January just a lost cause for restaurants?
Think about consumer behavior in Q1. People are recovering from massive holiday credit card bills.
True.
They are making New Year's resolutions to eat healthier or, cook at home more. It is traditionally a very tough time to convince someone to come out for a deep dish pizza and a craft beer.
Yeah, that makes sense.
So rather than spending millions of dollars shouting into the void in February, trying to force demand that just isn't there, they held their fire.
It's like saving your entire fireworks budget for the 4th of July instead of lighting off a few sparklers every random Tuesday in March.
That's an excellent way to conceptualize it.
If you're going to spend the money, you want to spend it when the audience is actually looking up at the sky, ready to be entertained.
Exactly. Though in this case, it's more like they realized none of their competitors were setting off fireworks at all because they were all trying to save money. So BJ's just bought out the whole fireworks store for the 4th of July, and the data proves that this concentrated burst of marketing was wildly effective.
The numbers don't lie.
Right. By clustering that ad spend into Q2, they achieved a 67% increase in marketing impressions during the quarter.
67% more eyeballs on their ads just by shifting the calendar.
Yes. And the brilliance of it is that on a year-to-date basis, like looking at the first 6 months of the year combined, their total marketing dollars spent were actually flat compared to last year.
Wait, really? They didn't increase the budget at all?
Not a dime more.
Yeah.
But their efficiency, meaning the return on that ad spend, improved by 20 basis points.
So they didn't spend more money overall, they just spent it significantly smarter.
Much smarter.
And they capitalized on people who were already looking for a place to celebrate. I mean, the transcript results are undeniable. They reported that Mother's Day sales jumped 8% year over year.
Which is huge for an already busy day.
Father's Day grew 3%. They explicitly stated that over 80 of their restaurants broke their all-time daily or weekly sales records during this quarter.
80 locations breaking records.
80 restaurants. That is not a seasonal fluke. That is a systematic operational success.
It is a massive operational flex. But as any marketer will tell you, it's not just about yelling louder during the holidays.
Right. You need a good product.
You can run all the TV commercials and Instagram ads in the world, but if the product doesn't resonate, the customer won't convert.
Yep.
You have to have a compelling offer to match the marketing volume. And this brings us to what might be the most structurally powerful weapon in the BJ's arsenal right now.
Wait, you're saying a single menu item is acting as a structural weapon?
I am.
Because I saw this in the transcript, but I assumed it was just corporate fluff. We have to talk about the Pizookie.
We absolutely do. The Pizookie, for those who don't know, it's their signature dessert, a warm deep dish cookie baked in a skillet, topped with massive scoops of ice cream.
It's so good.
It's incredible. But it is doing incredibly heavy lifting for the entire brand equity of the company right now.
The earnings transcript specifically highlights the rollout of the Biscoff Pizookie. And I have to admit, purely as a consumer, I get it. Caramelized biscuit spread, vanilla bean ice cream, a warm cookie. It's a home run.
It's a total home run.
But the numbers attached to this are what really blew my mind. Management stated that Pizookie incidents literally doubled year over year during the quarter.
Doubled. Let that sink in.
Doubled. But let me play devil's advocate here. How does a single dessert single-handedly move the needle on a $388 million quarter?
It's a totally fair skepticism.
Because if I'm an investor, I don't want my investment thesis resting on a warm cookie. Walk me through the actual unit economics here.
A dessert alone doesn't save a quarter. But it's not just a dessert. It's a structural traffic driver anchored by a very specific promotional vehicle.
Okay, what is it?
They call it the Pizookie Meal Deal, or the PMD. Let's break down the psychology and the economics of the PMD, because this is where the genius lies.
Walk me through it.
It's a bundled offer. You get a specific entree and a Pizookie for a set, attractive price, usually around $14 or $15, depending on the markets.
Okay.
Management noted that this specific deal is engineered to do two very precise things for their traffic curve.
Okay, what is the first thing?
First, it is designed to drive the younger demographic Gen Z and young millennials, who are notoriously hard to reach and highly price sensitive right now, into the restaurants on Tuesdays.
Wait, why Tuesdays?
Because Tuesday is traditionally a dead zone in the restaurant industry.
Oh, that makes sense.
Nobody goes out to a full-service sit-down dinner on a Tuesday unless there's a really compelling reason.
Right.
By offering a high-value, highly craveable bundle on a Tuesday, they're essentially manufacturing demand out of thin air on a day where the fixed costs of the building are already dragging down the weekly profit.
So they're weaponizing a slow day. I love that. Okay, what's the second thing the deal does?
Secondly, on Fridays and weekends, the PMD is opening up what management calls the social splurge occasion.
Social splurge. I love that term. What does social splurge actually mean in behavioral economics?
It addresses the friction of going out with a group right now. If a group of friends or a family of four wants to go out on a Friday, the perceived cost of a sit-down meal is really daunting.
It is. You look at the menu and flinch.
Right. Everyone assumes it's going to cost $25 or $30 a head minimum. The Pizookie Meal Deal acts as a psychological safety net.
Oh, I see.
It gives them a perceived, guaranteed value that makes the decision maker say, yeah, let's go out tonight to BJ's. I know exactly what it will cost, and it won't break the bank. It completely removes the friction from the decision.
Ah, okay, so the X-ray comes completely back into focus now. This ties directly back to my initial panic about check compression.
Exactly.
The Pizookie Meal Deal is the exact mechanism bringing in that 8.3% traffic surge. But because it's a $15 value bundle instead of a $25 a la carte order, it's dragging the average check down by 1.8%.
Precisely. The PMD is the prime suspect for the check compression. But again, look at the margin flow through. The volume absolutely crushes the check compression.
Because they're selling so many of them.
Right. You have double the amount of people ordering this highly craveable item. And let's not forget the core unit economics of the food itself.
What do you mean?
What goes into a Pizookie? Flour, sugar, butter, and a scoop of ice cream.
Literally the cheapest ingredients on earth.
Exactly. The profit margins on flour and sugar are astronomical compared to a piece of protein like chicken or beef.
Right.
Even baked into a discounted meal deal. Shifting your product mix so that a massive percentage of your customers are consuming high-margin flour and sugar is an incredibly profitable endeavor when executed at scale.
That is fascinating. They are trading down the top-line revenue per ticket, but protecting the gross margin percentage by serving way more dessert.
Exactly.
But speaking of margins and food costs, we really have to talk about the friction in the supply chain because it wasn't all sunshine and Biscoff cookies in Q2.
No, it definitely was not.
Let's talk about slaying the inflation dragon because this part of the transcript is just wild.
This is perhaps the most impressive part of the entire earnings call. What's fascinating here is how they manage their operational costs against some, frankly, terrifying macroeconomic headwinds.
Terrifying is exactly the right word. I saw this line in the transcript and my jaw actually dropped.
I know exactly which line you're talking about.
The CFO reported overall commodity inflation of approximately 5% for the quarter. Now, 5% inflation on your food basket is annoying, it eats into profits, but it's manageable.
Right, you can deal with 5%.
But underneath that blended 5% basket, they reported a staggering 20% spike in beef costs. 20%.
It's massive.
Plus, they mentioned elevated produce prices due to severe weather events impacting crops and higher transportation costs just to get the food on the trucks.
Right, and you have to put that in context. For a restaurant brand whose menu is heavily anchored by burgers, steaks, prime rib, and, meat-loaded deep dish pizzas.
Yeah, they use a lot of beef.
A 20% surge in the cost of beef is a direct, violent hit to the chest. Management noted that this beef inflation alone created a 120 basis point headwind on their cost of sales.
Wow.
Yeah, pushing their total cost of sales up to 25.5% of total revenue.
Okay, wait. I am looking at this diagnostic x-ray again, and I need you to reconcile something for me because the math feels totally broken right now.
Okay, let's look at it.
You just told me earlier that their overall restaurant-level operating profit margin actually went up by 20 basis points?
Yes.
But you're now telling me their core ingredient costs spiked by 20%, dragging down their cost of sales by 120 basis points.
Also, I guess.
You can't just absorb a 20% hike on your most expensive ingredient magically. Something else in the business model had to give to create that profit. Where did they find the money?
It wasn't magic. It was a combination of that raw volume we discussed and a massive leap forward in technology.
Technology in a restaurant kitchen.
Specifically, they utilized labor leverage driven by a new AI scheduling system.
Okay, wait.
Let's translate labor leverage first, because it's a term Wall Street loves, but it's rarely explained well.
Please. Ground this in the reality of running an actual kitchen.
Okay, as we discussed with the fixed costs of the building, labor in a restaurant also operates somewhat rigidly, especially at the baseline.
Right.
Just to physically open the doors at 11 a.m., you need a host at the stand, a bartender, a minimum number of servers on the floor, and a full line of cooks in the kitchen. Someone on grill, someone on saute, someone on pizza.
The skeleton crew.
Exactly. If you have a slow, dead Tuesday, your labor cost as a percentage of your sales is astronomical because you are paying all those people to stand around waiting for orders that just aren't coming.
You're bleeding hourly wages for zero return.
Exactly. But if you execute a marketing plan and a Pizookie meal deal that drives an 8.3% increase in traffic, those exact same 5 cooks on the line are suddenly operating at maximum capacity.
They are slammed.
They are cooking nonstop. You are generating significantly more top-line sales for the exact same hourly wage payout you were going to make anyway. That is the definition of labor leverage. The sales grow much faster than the labor expense required to service those sales.
I'm not entirely buying that just yet.
Why not?
I understand the baseline theory, but let's be real. An 8.3% traffic spike, especially when it's concentrated on specific promotional days or weekends, requires some extra labor.
You would think so.
You can't just work your existing team to death. If 40 extra people walk in the door at 6 p.m. and the kitchen isn't prepped for it, ticket times go from 15 minutes to 45 minutes.
And that's a disaster.
Exactly. The food gets cold, tables don't turn, tips drop, servers get angry and quit, and the customers leave bad Yelp reviews. You have to add a server, a busser, or a prep cook here and there to handle an 8% surge.
You are 100% correct about the friction of a busy kitchen. If you just throw 8% more bodies into a poorly managed restaurant, the operational wheels fall off entirely.
It's chaos.
Absolute chaos, which is exactly where the technology aspect comes in and why BJ's succeeded where others would fail. Management specifically highlighted the system-wide rollout of what they called their AI-supported activity-based labor model.
Okay, here is where it gets really interesting. Activity-based AI scheduling. What does that actually mean in the trenches?
It's a game changer.
Like, what does AI scheduling mean for the 19-year-old kid trying to get his shift covered? How does it differ from how restaurants have always done it?
Historically, a restaurant general manager sits in the back office on a Thursday afternoon with an Excel spreadsheet and a lot of guesswork.
Well, I've been there.
They look at a blunt sales ratio. They say, okay, last year on this week, we did $10,000 in sales on a Friday night. So my corporate labor matrix says I get X number of total labor hours to spend.
It's super basic.
It's a blunt instrument. So they schedule 5 cooks to come in at 4 p.m. and stay until 11 p.m. But if the rush doesn't actually start until 6:30 p.m., you just paid 5 cooks for 2.5 hours to prep and basically stand around.
Right. It's wildly inefficient.
An activity-based labor model, supercharged by AI, completely destroys that spreadsheet. The AI doesn't just look at gross sales targets.
What does it look at?
It ingests massive amounts of data. It looks at historical ordering data down to the item level, local weather patterns, local events like a high school football game down the street, and the specific mix of promotions running that day.
That's crazy.
It uses all of that to predict exactly what tasks will need to be done at exactly what minute of the day.
Give me an example of how that changes a shift. Let's make it concrete.
Sure. The AI doesn't just say, we need 5 cooks tonight. It says, based on historical Tuesday patterns for the Pizookie meal deal, plus the fact that it's raining, which increases delivery orders, we project a massive surge in dessert and pizza orders between 6:15 p.m. and 7:45 p.m.
Okay.
Therefore, do not bring all 5 cooks in at 4 p.m. Bring 2 in at 4 p.m. for prep. Bring the pizza cook in at 5:30 p.m. Bring a dedicated dessert plater in at 6 p.m.
Wow.
But keep the fry station and the grill station light because people are ordering pizza. It staggers the arrival times in 15-minute increments based on predicted activity.
It is micromanaging payroll down to the minute based on exactly what food the AI thinks people are going to order before they even walk in the door.
Exactly. It allows the manager to surgically schedule the right people in the right specific spots on the line at the exact right moment rather than just throwing a wall of bodies at the dining room and hoping for the best.
That is insane.
And the financial proof is undeniably in the transcript. Despite serving 8.3% more guests, total labor and benefit expenses actually improved by 90 basis points.
Wait, their labor costs went down while serving more people?
Yes, dropping down to 34.5% of sales.
That is staggering. So let me summarize this mechanism because this is the whole puzzle right here. They leveraged the massive sales growth from the marketing. They executed this microscopic AI scheduling discipline to eliminate wasted hourly wages. And the savings they generated from being that efficient with their labor completely offset the massive 20% spike in beef costs.
Yes,
Yeah.
that's exactly it. They used technology and volume to shield their margins from commodity inflation.
That's incredible.
That is what top-tier operational execution looks like in a very difficult industry.
It's basically a masterclass in modern restaurant management. You drive traffic with surgical marketing and a killer value prop. You absorb the raw material inflation through sheer foot traffic volume. And you optimize your labor with AI to squeeze out margin expansion at the bottom.
It's beautiful to watch on a balance sheet.
Okay, so we know what happened in Q2. The history is written, the quarter is in the books, but you and I both know the stock market is a forward-looking machine.
Always.
It doesn't care what you did yesterday. It only cares what you're going to do tomorrow. The X-ray shows the patient is healthy today, but what is management saying about the rest of 2026?
They were projecting significant data-backed confidence.
Good.
The headline for the forward-looking portion of the call is that they are raising the roof on their guidance for the rest of the year.
Let's run through the upgraded full-year outlook, because this is where the actionable data for investors really sits.
Absolutely.
They raised their comparable restaurant sales guidance from a previous conservative range of 1 to 3%, all the way up to 3 to 4%.
Nice bump.
They raised their restaurant-level operating profit target to a range of $228 million to $235 million. And they bumped their adjusted EBITDA guidance up to $145 million to $152 million. Every single major financial metric was revised upwards.
And if we connect this to the bigger picture of the restaurant sector, raising guidance across the board in the current casual dining environment is a massive flex.
Huge flex.
When other CEOs are literally blaming the consumer and lowering expectations, BJ's is raising them. It tells institutional investors that Q2 wasn't just a seasonal Mother's Day fluke.
They think it's sustainable.
Right. Management believes this traffic surge is a sustainable structural trend. But, and this is a crucial but, they still have to address the elephant in the room.
Check compression.
You have to fix the check compression.
Right, because you can't rely on traffic growth alone forever.
No, eventually you max out the dining room.
Eventually, you run out of new customers to steal. You have to get the people already sitting in your booth spending more money to combat inflation over the long term. So, what is the specific game plan for getting that average check back into positive territory?
Management laid out two main strategies. First, the blunt instrument, pricing power.
Okay, just raising prices.
Yeah. They implemented a 1.1% effective menu price increase in late June.
Yeah.
Because that happened so late in the second quarter, we didn't really see the financial impact in the Q2 numbers we just discussed.
Right, it wouldn't have shown up yet.
But management expects that price hike to roll through the system, leading to an effective pricing increase of 3.7% in the third quarter and roughly 2.6% in the fourth quarter.
So just straight up raising the price on the menu slightly to offset the inflation and pad the check size. That's standard operating procedure.
Very standard.
But they also talked about something way more interesting regarding the menu architecture itself to combat check compression.
Yes, the premium tier.
Tell me about this.
Management announced they are currently testing a premium tier for the Pizookie meal deal.
Okay, I love the behavioral psychology of this. Explain exactly how a premium tier works in this context.
Think about the life cycle of a customer. The standard $15 Pizookie meal deal is currently a fantastic customer acquisition tool.
It gets them in the door.
Right. It gets the price-sensitive Gen Z diner or the budget-conscious family in the door. It completely removes the friction. But once you have captured that customer, once they are sitting in the booth and actually looking at the menu, you want to give them a psychological pathway to trade up. A premium tier might offer a higher-end entree, maybe a premium bacon cheeseburger, or a small sirloin steak, or especially pasta bundled with the Pizookie for, say, $18 or $19 instead of $15.
Ah, it's classic price anchoring.
Exactly. It maintains the core value proposition that brought them in. You still get the variety of a full meal and the signature dessert you craved, but it allows the guest, who is suddenly feeling a little flush or who is really hungry, to rationalize spending more money.
That makes total sense.
They see the $15 deal, but the $19 deal looks really good, and they think, well, I'm already saving money compared to a la carte. I might as well get the steak.
It's brilliant. It really is. Management explicitly guided that because of the combination of those direct price increases and this menu engineering to force trade-ups, they expect check averages to return to positive growth by the fourth quarter.
And this is the critical math for an investor.
Laid out.
If they pull that off, if they maintain even half of this incredible 8% traffic momentum, and D, they flip the check average back to positive growth by getting those people to spend more, the profit flow through to the bottom line is going to be absolutely explosive.
Which brings us to the balance sheet, because all of this expanding operating cash flow has to go somewhere.
It definitely doesn't just sit in a vault.
Right, and this is where my retail investor ears really pricked up during the call. During the quarter, they slashed their net debt basically in half.
That's huge.
They started the year at $61 million in net debt. They aggressively paid down $18 million in the second quarter alone, and they are now sitting at just $30 million in net debt.
Wow.
Plus, they bought back 64,000 shares of their own stock for $2.4 million.
This is a masterstroke of capital allocation. Let's talk about why aggressively reducing debt is so crucial for a restaurant right now.
Please do.
The CFO, Todd Wilson, mentioned their blended cost of debt is around 5%. Now, 5% is actually quite a low interest rate in 2026.
Yeah, that's pretty cheap money.
But by aggressively paying that principal down anyway, they're doing something vital for the long-term health of the company. They are buying optionality.
Let's round optionality and blue-collar realities. What does that actually mean for the restaurant manager on the ground?
Okay, when a company is saddled with $60 million in debt, a massive chunk of the raw cash you generate every week goes straight to the bank just to service the interest.
Right.
You can't fix a broken air conditioner. You can't replace the torn vinyl on the booths. You can't update the patio furniture because the bank gets paid first.
That makes sense.
When your balance sheet is clean, when your debt is low, that cash flow stays in your pocket. It gives you the freedom, the optionality to play offense. And BJ's is deploying that freed up capital beautifully.
How so?
They are remodeling 5 locations, and crucially, they are investing heavily in what they call gold standard equipment and facility maintenance.
Let's pause on that because it's so important. They specifically cited a $1 million increase in spending during the quarter just to address deferred facilities work. Now, on paper, if you're a short-term trader, $1 million expense hurts the quarter's net profit.
Oh, Wall Street hates it in the short term.
Right. But as a long-term investor, this is music to my ears. We have all been in that chain restaurant where the AC is struggling in July, the bathroom door doesn't latch, the booth vinyl is cracked and taped over, and the dining room just feels, tired.
It's the worst.
That deferred maintenance is the slow, agonizing bleed of death for a restaurant brand.
It absolutely is. You cannot charge $20 for a burger in a dining room that feels like it hasn't been updated since 2012.
No one will pay it.
Management realizes that the physical atmosphere is a core competitive advantage. If you want to institute price hikes and charge a premium, the building has to feel premium.
Exactly.
By aggressively maintaining the gold standard, by fixing the AC and replacing the booths, they protect the brand equity. And because they have the cash flow from the debt reduction, they're also back to building new restaurants.
Right. They are opening 2 new units in Q4, I think.
Yes. One in Buckeye, Arizona, and one in Joliet, Illinois.
Buckeye being a proven, established market for them, and Joliet being a new development market. They're carefully, methodically turning the growth engine back on.
It's smart, measured growth.
Okay, we have the data, we have the story behind the marketing and the menu psychology, and we have the forward guidance and capital allocation. Time to wrap this up.
Let's do it.
So what does this all mean for you, the retail investor listening right now? What is the bottom line on BJRI?
I'm going to give a firmly bullish verdict on this quarter, this management team, and the company's forward trajectory.
Bullish. Okay, lay out the closing argument. Convince me.
If we connect everything we've discussed today to the bigger picture, you have to look at the industry context. Look at the black box intelligence data that was cited on the call.
And for those who don't know, Black Box Intelligence is the gold standard benchmark data provider for the entire restaurant sector, right?
Yes, exactly. Black Box aggregates the credit card data and foot traffic data for the entire casual dining industry. And according to Black Box, the casual dining sector as a whole is seeing negative traffic right now.
The consumer is pulling back.
Heavily.
Yeah.
Yet, in that exact same brutal environment, BJ's beat the industry traffic benchmark by over 9 full percentage points.
Oh, wow. That is not a rounding error. That is violent market share theft.
Exactly. They are actively draining market share from their competitors. Anyone can discount their menu to get a temporary, unprofitable pop in traffic.
Right, verse to the bottom.
But to drive an 8.3% traffic surge, completely absorb a 20% spike in beef costs through AI labor efficiencies, expand your operating margins, pay down half your corporate debt, and raise full-year guidance all at the exact same time.
It's crazy.
That is exceptionally rare operational execution.
It really is the holy grail of restaurant earnings. So the actionable takeaway for you, the retail investor, is this. If you hold BJRI, or if you are looking for an entry point into the consumer discretionary sector, this is a story of a management team that is pulling all the right levers at exactly the right time.
Perfectly timed.
They are driving massive traffic today, and they have a clear, mathematically sound plan to fix the check compression tomorrow. If they successfully roll out that premium Pizookie meal deal and get the average check positive by Q4 as promised, the leverage on the stock could be massive.
It really is a textbook case of a management team controlling what they can control.
Right.
They cannot control global beef prices. They cannot control the Federal Reserve or the macro economy, but they can control their marketing timing, their menu architecture, their facility maintenance, and their labor efficiency. And right now, they are executing on all of those fronts flawlessly.
Okay. That is going to wrap up our Talk Tickers breakdown of BJ's Restaurants' Q2 earnings. We wanted to give you the raw data, the translation of the jargon, and the actionable plan, all at an energetic pace. Thank you for joining us for this deep dive.
But before we go, I want to leave you with a final thread to pull, something we touched on, but has massive implications for your entire portfolio.
Ooh, what is it?
Think about that AI labor model BJ's is deploying. In an industry notoriously plagued by razor-thin margins, unpredictable rushes, and high turnover, could AI scheduling become the ultimate dividing line in the hospitality industry?
Oh, that's a brilliant thought. Will the future of casual dining literally be split in two?
I think it might be.
On one side, the tech-enabled operators like BJ's who can dynamically flex their labor to the minute, protecting their margins, surviving inflation, and thriving.
Right.
And on the other side, the legacy operators still sitting in a back office using 1990s Excel spreadsheets, overstaffing their slow nights, burning cash, and slowly bleeding out.
It really makes you wonder if tech adoption, rather than the food itself, is the new moat in the restaurant business.
It's definitely something to chew on as you look at other restaurant stocks. All right, that's all for today. Remember, the market is a puzzle, so keep digging into the data, and we will see you on the next deep dive.